Japanese yen has just collapsed, and it's not because of the Bank of Japan, not because of US yields, but because of politics. Over the weekend, Japan's ruling party elected a new leader and the market reacted instantly. Dollar yen blasted through 150, Japanese equities jumped almost 5%, and the question everyone's asking is simple: can dollar yen hit 160 again? So let's break down what's happened, why it matters, and what we can expect going forwards. Over the weekend, Sanae Takachi, I may have mispronounced that, unexpectedly won Japanese Liberal Democratic Party leadership election, putting her on track to be the next prime minister. She's known for her Abenomics style policies, basically more government spending, looser monetary policy, and a focus on boosting growth. Now, what does that mean? Well, rate cuts, but we'll get there. And of course, the markets loved it. Dollar yen jumped past 150, the Nikkei 225 jumped almost 5%, long-term Japanese bond yields spiked, and short-term yields fell, meaning traders now expect fewer Bank of Japan rate hikes. This wasn't just a regular leadership election. This was almost a complete policy reset, which is why the markets had such a violent reaction. So before her win, the markets were pricing in roughly around 14 basis points worth of hikes by the end of October. However, after her victory, this has now dropped to around 6 basis points, which is less than half of what it was. Takachi wants to revisit the 2013 joint policy statement between the government and the Bank of Japan. This agreement defines the central bank's independence. We've seen a very similar problem within the Fed and Trump in terms of the fears in the markets, fears with investors about the Fed's independence. We're now seeing a similar thing around the Bank of Japan. So this has spooked investors. It suggests more political pressure on the Bank of Japan to stay easy and support fiscal stimulus. Add that to her fiscal promises of cutting fuel taxes, raising income deductions, issuing more deficit bonds, and a government ready to spend big and weaken the yen. So the markets went full risk on. The yen sold off, Japanese equities rallied, and yields at the long end of the Japanese government bond curve spiked. So this goes a little bit deeper than politics into the yield gap. This chart shows the US 10-year yields against the Japanese 10-year yields, or the JGBs, which the US is in purple and the Japanese are in orange or red. The US is sitting around 4.15% and Japan is sitting at 1.68%. So this is a big yield gap, and this differential is basically one of the biggest drivers of the dollar yen. So as long as the US 10-year yields here stay above these Japanese 10-year yields, we will continue to see the yen get pressured. However, this is the key. The Fed is looking to cut rates. We've already had a 25 basis point cut in the previous decision. Now, Powell did rule this out as a risk management cut. However, since then, we've had very poor ADP. We've had the government shut down, meaning there's a serious lack of data. So the risk is still there that we have further rate cuts from the Fed. And of course, that would start to reduce this yield gap. So in the short term, it's almost certain that the yen is going to stay weak. Fiscal stimulus with the addition of political pressures from the Bank of Japan equals a weak yen. 152 and 155 on the dollar yen are where the MOF, where the Ministry of Finance, start getting very uncomfortable. So once we hit these levels, we can expect some sort of intervention talks in the market. And if momentum continues to the upside, you should start to expect some sort of intervention from the MOF. Now, an intervention is essentially when the Ministry of Finance will step in, slow down the depreciation of the yen against the dollar by boosting the value of the yen, basically, put in simple terms. We've seen this many, many times on the yen when the dollar yen will just completely plummet to the downside and correct within a couple of hours back to the upside. However, that initial move to the downside can be very violent, very aggressive, and very difficult to deal with if you are trapped in long positions. A lot of traders' eyes are currently on the 160 level on dollar yen. So could we realistically reach this? Well, yes, we could realistically. However, it would take essentially a perfect storm. We need to see a few different things start to come into fruition, which could be the Bank of Japan completely freezing the normalization policy, the government go all in on stimulus, ignoring the debt risk, the Fed pause cuts or flip hawkish, and global markets stay risk on, reducing the demand for safe havens like the yen. So as you can see, this actually makes it relatively difficult to be a trader in dollar yen, because the MOF is known to give very little insight or basically no warning at all that they are going to intervene. So we could come up to this level and see nothing. We could come to this level, see nothing. We could come to this level and see nothing. Then we could come here and we could see some sort of intervention. So short term, it might be quite nice to be an intraday buyer or even a scalper to the long side on dollar yen. However, holding swing positions could get quite dangerous because we don't know if or when we might get that intervention by the MOF. The next point is, as I just mentioned, it would take a perfect storm to see 160 again. Now, we could see all of those factors come into play and we see a rally to the upside, or what is a bit more likely is we actually see something a little bit more slow and gradual. As we see the yen continue to get pressured, we see the Fed rate cuts continue to get priced in, and then we get that drift to the upside as the carry trade continues. We see a reduction in positive sentiment around the yen, and obviously the US dollar is the global currency. It's the big boy. So demand for the dollars will always be there, or at least for the foreseeable future. So this is my idea. I'm going to take very low risk tactical longs on dollar yen and all of the yen pairs, pound yen, euro yen, obviously not at the same time, not getting overexposed, but I will be looking to be a buyer of any of the markets that will give me an entry and book profits pretty quickly. I don't want to hold all the way, or I don't want to hold a position trying to get to 160. I would rather move, take some profits, see the move, take some profits, see the move, take some profits, rather than trying to hold some massive position. Ladies and gentlemen, that is it from me today. Please drop a like and subscribe. You can join my Discord, link is in the description. Please stay safe, don't get margin called, and I will speak to you later. I hope this video has helped some people get some clarity. Speak soon.